Hi, my name is Paul and welcome to month number 8 of my $100 per month Canadian stock portfolio series. This time, I'll be covering the second quarter financial reports and earnings calls of MTY Food Group and the Morguard North American Residential REIT. I'll also be talking about how my portfolio has been fairly consistently beating the markets through both the recent market drop and the current rally. And as always, I'll be showing you exactly how I'm going to be investing this month's $100 of contribution, as well as the dividends earned over the past month. But first, if you're somebody that's new to the series and you're interested in hearing about the goals and rules that I have for investing in this portfolio, then you might want to check out the document linked in the description of this video, where I outline all of that in detail. With that said, I'm going to quickly give a brief recap of the companies that I hold within the portfolio. The largest holding is the Morguard North American Residential REIT, ticker symbol MRG on the Toronto Stock Exchange. Now, there are two other Morguards on the TSX, so make sure you're looking at the right one with the ticker symbol MRG. Morguard owns and rents out apartment units in cities and large suburbs throughout the United States and Canada. And the reason that I've been investing in Morguard is because I believe it is trading at a heavy discount to the net value of its properties, while offering a better price to net operating income than its peers. Also, because Morguard's properties are strategically located in cities and large suburbs that are expected to continue to see population growth over the coming decade, I believe it will give me a good return on my capital over the coming years, and it's my strongest conviction currently in the market. The second largest holding in my portfolio is MTY Food Group, with the ticker symbol MTY, and it also trades on the TSX. MTY operates and franchises fast food, casual dining, and other specialty restaurants, mostly within the US and Canada. But more recently, MTY has begun selling and distributing retail food products centered around their successful franchise brands. One of the most important factors contributing to my investment into MTY is the strong history of success in acquisitions and the high level of insider ownership. Also, based on the management's capital allocation decisions, MTY feels like a company that's being run with its owners' best interests in mind. In addition to that, MTY has historically provided very good shareholder returns and is currently trading at low earnings and free cash flow multiples compared to its slower growing competitors. The third and final holding in the portfolio is Knight Therapeutics, which trades under the ticker GUD on the Toronto Stock Exchange. Knight is a specialized pharmaceutical company that predominantly operates in Latin America through the licensing, marketing, and distribution of pharmaceutical drugs. What originally drew me to Knight Therapeutics was the past success of the management team, who have built a business around acquiring mature and underpromoted pharmaceutical products that have the ability to return capital with minimal added expenses. Currently, Knight trades at a considerable discount to book value, and I believe that the intangible assets from recent acquisitions will return tangible growing capital to the business over time. On top of this, Knight loans money to biopharmaceutical companies in return for exclusive rights to purchase, market, and distribute successful products developed by the borrowers, which is a low-risk, high-reward model that I believe is being overlooked by the market. And as of now, that's everything that I currently hold in my Wealthsimple portfolio. If you happen to be interested in a more detailed breakdown of these individual investments, then I'd recommend going back and watching the series from the beginning. In the first couple of episodes, I cover my reasoning behind these investments in depth, and I continue to build on this throughout the series. So if you go down into the description box below the video, there will be a link to the portfolio series playlist, which has every episode in this series in order from first to last for your convenience. With that, let's get into the meat of the video by covering the news and financial results that came out over the period of the last month, and there really is a lot to get through. First, I'm going to start with Knight Therapeutics, since Knight is the only holding that didn't release Q2 earnings in July. Knight did, however, renew their normal course issuer bid and are allowed to repurchase nearly 8 million shares for cancellation, which amounts to about 10% of the company's public float. Also mentioned in the NCIB announcement was that Knight completed its previous bid by repurchasing for cancellation over 10 million shares, maximizing the number of shares allowed to be repurchased, and the company paid an average of $5.25 per share. Personally, I love seeing an undervalued company like Knight focus on buybacks, because it firstly shows that the management is confident that the business is worth more than what the market is giving it credit for, and secondly, it rewards shareholders by increasing their stake in the business. Looking back on the last few years, we can see that as the share price has dropped, Knight has been more and more heavily focused on repurchasing shares, which has lowered the total shares outstanding by over 18% in only 3 years. Aside from that news, Knight also announced that it will be releasing its second quarter results on August 11th and that it will be holding its conference call after the financial results have been posted. Now let's dig into MTY's quarterly results, which for me was a bit of a mixed bag, but probably had a slight lean towards the positive side. Firstly, second quarter revenues were up over 15% from the first quarter of this year, and revenues were up over 19% when compared to the second quarter of last year. Now, virtually all of this increase came from the Canadian side of operations, which was up 42%. Meanwhile, the US and international portion of the business declined by 1%. But as I've explained in the previous quarter's analysis, this decrease is because of the sale of Papa Murphy's locations, which were previously generating significant corporate revenue in Q2 of 2021. Now, I don't recall if I've explained this before, but I'm going to quickly go over why MTY would choose to franchise out its corporately owned locations, which will almost always generate more revenue than a franchised location. The reason is because while corporate locations bring in more revenue, they also cost significantly more to operate. So because of the costs required to run a location, receiving recurrent payments and royalties from someone else who wants to operate your proven successful concept is generally going to be more profitable than actually running the store yourself. Plus, franchising has the added bonus of sidestepping most of the costs associated with restaurant product sales, and it even sidesteps some of the capital expenditures, like kitchen appliances and equipment. This further allows the franchising company to free up cash that would otherwise be needed to maintain operations, allowing a company like MTY to instead allocate money towards returning capital to shareholders or investing it themselves into other growth initiatives. But I digress. Going over Canada's Q2 numbers, revenues soared thanks to pandemic recovery, which boosted franchise system sales and corporate location revenues significantly higher than last year's second quarter results. Meanwhile, food processing and distribution also saw a large revenue spike upwards, which was mostly due to new product listings and geographic expansion. This was very nice to see, and it came despite MTY offering one less retail product than in the previous quarter, which is somewhat of a negligible decline. Personally, I think that with the number of new products created for stores over the past year or two, there are bound to be some that aren't winners, and I think it's definitely better to be rotating those ones out to focus on the products that are selling. While I'm on the topic of retail, there was also a mention in the conference call that the retail segment has lots of exciting growth opportunity ahead, with internal goals set to increase production, find more suppliers, and expand geographically, which of course is everything that I want to hear as a shareholder. Unfortunately, while revenue growth was high, operating expenses managed to grow slightly faster, which to me was a bit worrisome upon first glance. Thankfully, the majority of expense growth came via vacant staff positions being filled on top of the inflationary impact on wages, and were deemed controllable expenses in the report. Also, during the conference call, it was mentioned that the loss of qualification for COVID-related wage relief did have an impact on margins. So this news wasn't quite as bad as I initially thought it was, but it still wasn't good news by any means. There's a lot more on this topic that I'll be covering momentarily, but for now I want to go back to talking about the numbers that the company put up. So, free cash flow came in at $1.06 per share, which was actually lower than last quarter's, and this was a bit surprising to me, even though it probably shouldn't have been. A few months ago, when I analyzed MTY's first quarter results, I said that free cash flow should be expected to increase throughout the year based on this chart highlighting MTY's top brand performance by quarter. Now that we have this month's numbers, it's clear that I was incorrect in that assessment. And looking at historical performance, it's obvious that the reason I was wrong was because I was extrapolating much more information than I should have out of this one slide. Instead, I should have looked at the historical quarterly free cash flow performance. If I did this, it would have been clear that the second quarter usually results in the lowest levels of free cash flow. So I apologize for that bit of ignorance on my part, and I'll do my best to be more vigilant going forwards. Also, in case you've noticed the discrepancies between the free cash flow metrics shown by Ticker and MTY, that's just due to the method of calculation being used. The main difference being that MTY's free cash flow calculation is net of disposals, meaning non-operational sales and associated fees and taxes are not included in their cash flow figures. Moving along, Eric Lefebvre, the CEO, did note on the conference call that the drop in free cash flow came from the additions to property, plant, and equipment and intangible assets, but didn't elaborate any further than that. So all we really know is that higher levels of investment are what led to lower levels of free cash flow. As for capital allocation, during the quarter, MTY repaid over $34.5 million of debt, but didn't repurchase any shares as of the 3 months ending on May 31st. On the conference call, the CEO did go over the utilization of capital by saying that the company is continuing to aggressively pay down debt in order to open up available liquidity for future acquisitions and to lower interest expenses until a suitable acquisition presents itself. Based on the language used in the call, it came across as though repurchases will be taking a backseat to debt repayment. As for how I feel about this, I think it's a good idea to be paying down debt considering that the Fed is taking actions to lower the rate of inflation. But I really would have liked to see the management repurchasing some shares back when the company was trading in the mid to high $40 range. But I'll hold off on any short-term judgment as the company may have their sights set on a lucrative acquisition, especially given that they did comment about venture opportunities increasing and the valuations reverting back towards historical levels. That said, the CEO did state that they're going to be staying disciplined and that they're unwilling to overpay for an acquisition, noting that they expect their history of picking up high-quality brands to continue into the future and that returns will reward shareholder patience. Also worthy of note was that during the call, a point was made to draw attention to the fact that the company currently has around $300 million of available liquidity. That much liquidity currently would make up over 20% of the company's market cap. So the potential is there for a very large move to be made if that's what they're looking to do. Speculation aside, MTY's business continues to be negatively impacted by COVID. This quarter, the company again had a net closure of stores, this time comprising 44 locations, which is an uptick from the previous quarter, though it is minimal in comparison to other recent quarters. Now, there wasn't an explicit outline of the details regarding these specific closures, but there was a brief mention that as of May 31st, 2022, 283 locations were temporarily closed, and subsequent to the quarter's end, most of these stores have reopened. On the conference call, there was also a question regarding when MTY expected to achieve a return to net openings. And the answer that was given was that it will probably be another 1 to 2 quarters. And part of what's been affecting this has been the delays on the transfer of possession of buildings to MTY. But these delays have now mostly been resolved and should positively impact the next quarter's net closures. Furthermore, Eric Lefebvre stated that COVID continues to negatively impact supply chain costs as well as some stores' operating hours, and that there are a few stores that will still need to close for 2 weeks to comply with quarantine protocol, although these COVID-related temporary closures are becoming less frequent. Some guidance was also given on the call in that the company expects sales to pick up as brands restore to normal operating hours and as business people and tourists return to urban areas. It was also remarked on that some brands within MTY's portfolio have been very resilient to inflation, while other more value-centric brands have been somewhat price-sensitive and slower to cope with the increasing prices. On a brighter note, it was acknowledged that staff vacancies are very low, and that the company's franchises are well-staffed. And it was also noted that discretionary income is still out there, and that the company currently has more demand than it can keep up with, which is very good news given the recent economic uncertainty. Also, despite the post-pandemic recovery and the resurgence of in-restaurant dining, digital sales continued to increase, with 18 of MTY's top 20 brands realizing growth compared to the second quarter of 2021, averaging 13.7% year-over-year growth. Finally, I want to end off MTY's segment by pointing out the rising trend of food dollars being spent in restaurants, in both Canada and the US. And this is a trend that doesn't look like it will be slowing down. Nearly 40% of Canadian food spending and over 54% of American food spending is done at restaurants. These numbers are huge, and they're likely being bolstered by teens, who, according to Piper Sandler, are prioritizing food spending. In Piper Sandler's 2022 spring survey, they found that food returned as the top spending priority among teens, coming in at 22% compared to 21% in the previous survey. Also, what needs to be realized here is that this is total wallet spend, as opposed to the other graph, which only tracks food spend. So for every dollar that these teens spend, over 20 cents are going to specifically food spending, which I think bodes very well for the restaurant industry since many of these teens will likely lead long lives of being regular customers of restaurants. To summarize, MTY's quarter wasn't really the greatest, but it really wasn't that bad either. And the long-term growth pathway still appears to be very clear and intact. Now, let's move on to the Morguard North American Residential REIT, which had a truly excellent quarter, in my opinion. Firstly, real estate revenue was up 12.7% over Q2 of 2021. This was due mostly to rental rate increases and lower vacancy, as well as partially to foreign exchange fluctuations. Net operating income, on the other hand, also saw an increase of 13.6% over Q2 of 2021, and most of this was due to better property performance, as well as the increase from the Louisiana redevelopment property, which hadn't achieved stabilized occupancy in last year's second quarter. These increases were also offset by the completion of the sale of the Atlanta, Georgia property, which will of course no longer be generating income for the REIT. For the 3 months ended June 30th, 2022, net operating income from the Canadian properties increased by 5.3% compared to Q2 of 2021. And this increase was primarily due to the Ontario rental rate guideline increases, as well as increases on suite turnover and lower vacancy, though this was partially offset by an increase in operating expenses. On the other side of the border, net operating income from the US properties increased by a whopping 17.9% compared to the second quarter in 2021. And this increase in NOI was primarily due to increases in average monthly rent and partially due to ancillary revenue increases and the positive impact of foreign currency exchanges, all of which was somewhat offset by marginally higher vacancy and an increase in operating expenses, plus the aforementioned stabilization of the Louisiana property and the disposition of the property in Atlanta, Georgia. Now, before I move on to discussing the average monthly rent and occupancy rates, I want to first briefly touch on the interest expenses, because there is a line item that tends to vary quite a bit and it does significantly impact the metric on a quarterly basis. That being the fair value change in the conversion option of the convertible debentures. These debentures were issued in 2018, and they yield the holder 4.5% annually and have a conversion value of $20.20 per unit. This means that one of Morguard's debentures costs $20.20, and each debenture can be converted into exactly one share. This means that when MRG's share price goes up, the fair value of the debentures become worth more, and when Morguard's share price goes down, the fair value of the debentures follows suit. So, because these convertible debentures are directly tied to share price, which tends to fluctuate a fair amount from quarter to quarter, this will regularly create disparity. It's also important to note that, like fair value gains or losses on property appraisals, which are reported on the income statement even though these changes don't represent cash inflows, the fair value gain or loss on the conversion option of the convertible debentures similarly do not actually represent a cash outflow. This metric only records the change in value of the debentures held, regardless of whether or not they have been converted into shares of the REIT. Hopefully that makes sense, and personally, when using formulas involving interest expense, I find it much more useful to eliminate this line item entirely, since it doesn't have any real bearing on the interest expenses that are regularly paid out by the REIT. Moving on, the Canadian property's average monthly rent per suite hit $1,565, which was an increase of 3% on last year's second quarter. Meanwhile, in the US, the average monthly rent reached $1,631, which represents an increase of 13% compared to Q2 of 2021. So, rents are up, and in Canada, this was in large part due to Ontario starting to allow rent increases again. Though raises were limited to 1.2%, with an exception for buildings wherein capital projects had been recently completed. In Morguard's case, this alongside suite turnover played a large part in higher rates of AMR in Canada. On the US side, however, the report only stated that US regions were showing strong fundamentals, and that market rents are expected to continue to be strong throughout the busy summer leasing season, in part thanks to the relatively limited supply of newly constructed units compared to previous years. So, only good news there. As for occupancy, Canada saw 95.2% compared to 91.8% at the end of Q2 of last year. In the US, demand continues to be fairly strong, coming in at 96.5%, which was down slightly from 96.8% in Q2 of the prior year. In Canada, this upwards move was created mostly by the lifting of COVID-related restrictions, leading to better economic conditions and more people returning to their normal routines. On the conference call and in the report, additional information was given regarding the Edmonton and Ottawa properties, both of which have been lagging the rest of the Canadian property portfolio due to their reliance on students attending the nearby universities leasing apartments. However, it was stated that both properties are starting to increase occupancy and should revert back to pre-pandemic levels once school comes back into full swing over the coming quarter. Stateside, despite the dip, it was noted that occupancy for most US properties have been outperforming pre-pandemic levels, and management expects occupancy levels to remain fairly stable throughout the summer leasing season, which was good to hear, especially considering that higher home prices have pushed many homeowners to sell into the market and start renting, which has been consistently increasing demand for available suites. It was also acknowledged in the report that this trend has continued through the recent Federal Reserve interest rate hikes, though this trend is expected to start slowing down in the fall and winter months. With that said, let's get into the big topic for Morguard this month, which was the acquisition and disposition of properties. First, as mentioned earlier, the REIT sold its Atlanta property for net proceeds of 93.16 million Canadian dollars. This property was constructed in 1988 and it was comprised of 292 suites, and the sale of this had a substantial impact on cash flows, making up the bulk of cash provided by investing activities. In this sale, the REIT also used a tax-deferred exchange strategy known as a 1031 exchange, which allows the REIT to defer paying taxes on the acquisition of a replacement property. And yes, in this quarter, it was announced that the Morguard North American Residential REIT did enter into an agreement to buy a new property. This acquisition is a multi-suite residential property comprised of 350 suites located in Chicago, Illinois, costing the company 171.38 million Canadian dollars, excluding closing costs. Now, there is more to go over here, but I want to first go back to the 1031 exchange, because upon closing the sale of the Atlanta property, $66.5 million in net proceeds went into the hands of a qualified third-party intermediary, which is what led to the large discrepancy in the line item cash used in financing activities. Also significantly impacting the cash from financing was the full payment of the mortgage associated with the Georgia property in accordance with the sale, and in addition to that, other mortgage repayments and of course distributions paid to shareholders, which was somewhat offset by the proceeds from new mortgages. Now, these weren't the only big moves made by the REIT this month. The management also managed to enter into an agreement to sell their property comprised of 340 suites located in Coconut Creek, Florida, for an expected net proceeds of 91.9 million Canadian dollars, excluding the closing costs. And this news came on top of the pending sale of the Slidell, Louisiana property, which was announced last quarter and is made up of 144 suites. On the conference call, management gave investors a lot more insight into their mindset and strategy regarding these deals, noting firstly that the REIT is focused on disposing of older properties that are likely to require additional capital expenditures in the near future. Expanding on this, the management stated that the properties being sold were built circa the 1980s, and that they have dated furnishing and decor. Also, the markets that these two properties are in have already experienced the full extent of expected rent increases, and they were sold at capitalization rates of roughly 3, which just means that the net operating income for these properties was about 3% of the total property value. Alternatively, you could think of it as though the properties are being sold for a price to net operating income of around 33, which is quite high considering the future expected renovation costs and the recent rent pushes. On the other hand, the Chicago market hasn't yet realized the same levels of rent increases, but the Chicago market is expected to see rent hikes of 12 to 18%, which the management plans to capitalize on. Plus, the building was recently constructed with a modern interior and is not expected to have any significant capex requirements anytime soon. And the best part is that the property was purchased at a cap rate of 4, which is substantially better than the properties that were sold considering the potential to grow AMR. On the final note of this topic, all of these acquisitions and dispositions are expected to close next quarter. But in the meantime, this has made a lot of important information a bit harder to follow. For instance, as of now, the REIT's total number of suites is expected to be a bit lower than currently reported. As of June 30th, 2022, Morguard owned 12,983 suites, with 484 suites held for sale and an additional 350 suites pending purchase. So, Next quarter, assuming everything closes on time, the REIT should have 12,849 suites net of acquisitions and disposals. So I don't doubt that this is going to have some odd effects on other important metrics like net operating income, but I feel like management has been doing a really good job at making these deals. So I don't really mind having to do a bit of extra work in order to accurately understand everything that's been going on. Transitioning over into capitalization rates, the weighted average capitalization rate of 4.2% was oddly down from 4.3% in Q4 of 2021. Now, you'd think that in a quarter where the net operating income saw such a strong increase, you'd similarly see a strong increase in cap rate. But because the REIT's property values have been increasing at a much faster rate, this instead managed to lower the average cap rate, which was pretty shocking to see, but in a good way. Switching things up a bit, if we take a look at the company's debt maturities, you can see that a lot of the mortgage debt, represented by the green bars, are going to be coming due over the next 4 years. But this isn't cause for serious concern, since the company already has enough cash and liquidity to pay off the mortgage into 2025, and that's without considering any additional mortgage refinancing. So, while the debt load does look a bit worrisome at first glance, given a more thorough examination, it does come off as reasonably manageable, especially considering that the loan-to-value ratio on the REIT's properties is well under 55%. This just means that the value of the mortgage debt is less than 55% of the underlying fair value of the property, with the mortgages on it. And the difference between the 55% mark and the remaining mortgage debt is visualized by the blue bars. So, in Morguard's case, there is a lot of underlying property value that could be liquidated in order to pay back the mortgage loans in a worst-case scenario where the REIT, for some reason, cannot manage to otherwise meet their obligations. Personally, I do not think that this is a very likely outcome. However, even in the circumstance where Morguard was forced to liquidate, in order for the mortgage loans to threaten the current discount to net asset value, North American property values would have to decline so significantly that it would need to dwarf the 2008 housing crash. On the other hand, the REIT's weighted average mortgage is growing at an annual interest rate of roughly 3.5% per year, and this debt has been leveraged to own properties whose underlying values have been rising at a much quicker rate. To understand the REIT's value net of all debts, I like to look at the tangible book value of the company. Last quarter, the tangible book value per share increased by over 11.5%, and for the full year, the tangible book value per share increased by over 31%. Better yet is that under Ray Sahi's management, the expanding property values are being locked in through the recent disposition of older assets, and the capital from these sales are being used to delever the balance sheet, as you can see from the recent quarterly decreases in total debt. Now, in the conference call, we also got some additional information with regards to the allocation of excess proceeds from the recent sales. This came in the form of the management responding that they're waiting to see how things play out in the market, but that they're also looking out for additional newer properties within their current geographic footprint, while continuing to work on disposing of older product that will require capital expenditures in the near future. Unfortunately, with this heavy focus on deal hunting and paying down debt, there is still yet to be any repurchases, which is a bit of a shame, especially considering that the management are aware of the large discrepancy between the market cap and the net asset value. But on the call, the management did respond to a question on the subject broadly by stating that they do foresee ways to get the price more in line with the net asset value, but that their focus is currently on the business and the assets, and that they're leaving it up to the investors to buy shares, which I'll no doubt be doing. Also, the usual distribution is expected to continue with no mention of any raises in the call or on the report. And that's it for this month's earnings news. I know that I've spent a lot of time here on earnings, so I'm going to try and cut down on parts that might be a bit more repetitive in the next segment in order to make the runtime a little bit shorter. If you end up liking or disliking these changes, then please leave me a comment letting me know so that way I can attune my content to your preferences a little bit better. With that said, let's move along and get into the portfolio's performance. But before I do, I want to give an update on last month's MTY order, which was left pending at the end of last month's video. Thankfully, within 24 hours of the video being published, the order was filled for about 0.45 shares, which have since gone up in value by 8.45%. And this is a huge upwards price move that wasn't exclusive to MTY. Last month's Morguard shares were also up over 7.3% before including the monthly dividend, and Knight Therapeutics shares increased by 3.15%. As of August 4th, the invested capital for the month increased by 8.56% when accounting for the dividends paid, pushing the total portfolio value to over $700. So my portfolio is now officially back above the total capital contributed, but is still slightly below the book cost, which also includes dividend capital. Based on the title of the video, you probably came into this well aware that my portfolio came out on top this month. But the extent to which my portfolio overperformed, especially compared to the Canadian ETFs, was shocking considering that every one of my holdings are stocks traded on the Toronto Stock Exchange. Now, monthly performance was skewed a bit this month due to the dividends received by all the benchmarks except for the Global Value ETF, which made it appear as though it was the worst performer. But if we take a look at the total portfolio performance, the worst performers were clearly the Canadian All-Cap and Canadian Large Cap ETFs, which are now lagging my portfolio by roughly 5% each. Now, the S&P 500 did stack up reasonably well this month. But if we look at this graph, which shows the portfolio gains net of contributed capital, you can see that even though my portfolio was less impacted than the prior month's dips, my portfolio has actually started to pull away, despite the market rallying and despite the Canadian markets as a whole performing worse than the American stocks. Also, it's not like I only have one stock carrying me ahead of the benchmarks. If you were to mark down the performance of each of my individual holdings, including their respective dividend payments onto the chart, each one would be ahead of the benchmarks. So why is it that these businesses are outperforming? Well, I believe it's because I've isolated businesses that are undervalued quantitatively and qualitatively. All three of these companies are misunderstood, and they trade at significant discounts from the standpoint of management capability, operational growth capacity, and fundamental metrics, which leaves several pathways open for market-beating growth. The reason that I was able to find these companies was because of the years of experience that I have studying business outliers and historically successful investors, as well as the methods that have led to their outperformance. And I'm confident that I've chosen some of the best businesses out there, and I think that if you have the same interest, patience, work ethic, and discipline, you can probably also achieve similar results. But while I did make this series to highlight what I consider to be relevant material for aspiring investors, I also made this series as a trackable way to prove that the average person who doesn't know much about finance or business can simply invest in broadly diversified index funds and still achieve good returns on their money. So while my portfolio has entered the green and the benchmarks are still in the red, I think it's important to be aware that over time these ETFs will also recover and grow. And just because right now they're showing negative returns, that doesn't mean that they're going to continue to do so. And it certainly doesn't mean that they're bad investments to be avoided. Plus, I need to point out that I've only just started this portfolio 8 months ago, which is an incredibly short period of time when we're talking about the stock market. So it is still very possible that my current outperformance is nothing more than positive variance. Either way, I felt inclined to speak up on behalf of the ETFs, since the current disparity in performance might lead a newer investor to believe that they must pick individual stocks to achieve positive results, when that absolutely is not the case. In fact, making uneducated gambles on the wrong company can lead to catastrophic losses that no investor should experience firsthand, though unfortunately many do. With that, I'll also mention that I'm still a ways off from my personal goal of a 12% annual return, though the gap has significantly narrowed from over $57 last month to now under $18. So the portfolio has made quite the comeback, but who knows where August will take it. To find out, I'll have to first invest this month's $101.40 in contribution and dividends. Now, even though there has been a bit of a rally in the market, I am still seeing some great opportunities. But like last month, I'm still going to just focus on buying the usual group of Morguard, Knight, and MTY. Morguard in particular continues to look incredibly undervalued, and the management's capital allocation convictions from Knight Therapeutics are very impressive to me. Meanwhile, MTY, having rallied strongly, still comes across as a good long-term business to be buying at the current price. So this month, I'm going to be buying the usual 4 shares of Morguard, and I'm also going to increase the number of shares of Knight Therapeutics I'll be buying this month by 1, so I'll be buying 3 total. And this mainly has to do with its valuation in relation to MTY Food Groups, which of course will receive the remainder of this month's capital. With that said, let's get into the clip of me buying shares. Alright, so I'm here in the Wealthsimple portfolio. It's almost 1 o'clock and we're going to get to buying. So we have $101.40 to spend. We're going to start with Morguard. We're going to be buying 4 shares just for market price. And that's just for market price. Next, we're going to buy our 3 shares of Therapeutics. Again, for market price. And then with the remaining $14, we will buy our fractional share of MTY Food Group. So we have $14.01. It looks like, yep. That fractional buy is going to be pending for a bit. It should come in for 3 o'clock. We'll see if that actually happens. Hopefully it doesn't get delayed like last month, but if so, we can deal with it. All right, see you on the other side. Okay, I'm back and it's good news. It's only been a couple of hours. So the order from MTY has been filled for $14 and I received about 0.237 shares. As for Knight, the 3 shares came in for $5.61 each, and the 4 shares of Morguard were filled at $17.64 each. So I'll input that into the spreadsheet and be right back. I'm back and taking a look at the portfolio now after the market close on Friday, August the 5th, 2022. Currently holds 32 shares of Morguard worth $568.29, 2.333 shares of MTY Food Group worth $138.36, and 18 shares of Knight Therapeutics currently worth $101.88. Also, there is no cash remaining in the portfolio at this time. That said, August should be a big month for dividend income. At their respective ex-dividend dates, the portfolio held 2.0956 shares of MTY Food Group, which should pay 44 cents, and I held 28 shares of the Morguard North American Residential REIT, which is expected to pay $1.64 in distributions. So, in the month of August, I expect to receive total distributions of $2.07, which is a pretty big jump up from last month's $1.40 received. Now, I know last month the portfolio only received a distribution from Morguard, but the dividend income has already started adding up, and it's exciting to think about the prospect of future dividend increases that are likely coming down the pipe in future quarters. If that does happen, then it'll probably only be a few years until the monthly dividend income surpasses the rate of monthly contribution. But for now, the portfolio has received a total cumulative distribution of $5.05, and at the end of next month, that should be up to $7.17. If we take a look at the portfolio's current annual yield, you can see that the portfolio can now expect to receive $24.35, assuming no changes, giving the portfolio a yield on contributed capital of 3.04%. And that's a 4 basis point increase from last month, which was almost entirely due to last month's pending order on MTY shares. And with that, we're out of time. So as always, I encourage you to use the information presented in this video as a starting point to do your own research into companies that interest you. This video is not financial advice, and it does not have the information necessary to make good investment decisions on individual securities. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions. I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value in this video. And if I did, then please consider sharing it with anyone who also might benefit from it. Thank you for watching all the way to the end of the video, and enjoy the rest of your day.